Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings. Today, we are diving into some interesting moves by Cooper Standard Holdings. Incorporated sounds like a mouthful. Right, this report is all about money and a big shakeup in their debt. Imagine you owe a bunch of people money and you decide to pay them back in a new way all at once. That's kind of what's happening here. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where you can connect with other finance enthusiasts. So on the 17th of February 2026, Cooper Standard Holdings Incorporated, or as we'll call them the company, announced through a press release that their subsidiary Cooper Standard Automotive Incorporated, also known as the issuer, is planning to raise a massive $1.1 billion by selling new notes. These are called senior secured first lien notes due in 2031. Think of it like taking out a new, bigger loan to pay off several older, smaller loans. The company says this new money will be used to pay back a collection of their existing debts. They're going to redeem all of their 13.50% cash pay or peak toggle senior secured first lien notes that are due in 2027. That is a mouthful, but basically it means they're paying off a debt that carried a really high interest rate, 13.50%. That is a pretty significant cost of borrowing. Next up are the 5.625% senior notes due in 2026, which they're calling the existing unsecured notes. And finally, they're also paying off their 5.625% cash pay or 10.625% peak toggle senior secured third lien notes also due in 2027. The point of this is to clear the slate and simplify their debt structure. They also plan to use some of the money raised to cover the costs associated with this whole operation and the debt payoffs. The success of this offering, meaning whether they can actually sell these new notes, depends on market conditions. It is also important to know that these new notes are not being registered with the Securities and Exchange Commission, or SEC, for sale to the general public. They are being offered only to specific types of investors like qualified institutional buyers. Now, on the same day, the 17th of February 2026, the issuer also sent out conditional redemption notices. This is essentially them telling the holders of their old debt that they intend to pay it off. They plan to redeem all of the existing first lien notes on the 4th of March 2026. The redemption price is set at 102.250% of the principal amount. This means they're paying back the original amount plus a small premium of 2.25%, along with any interest that is accumulated up to that date. Similarly, they're going to redeem all of the existing third lien notes on the 4th of March 2026 as well. The price for these is 101.410% of the principal amount, meaning a 1.410% premium plus accrued interest. And for the existing unsecured notes, they are also looking to redeem all of them on the 4th of March 2026 at a price of 100.00%, which is essentially just the principal amount plus accrued interest. No premium there. It's worth noting that these redemptions are conditional. They are dependent on the company successfully completing those refinancing transactions we talked about earlier, ensuring they have enough money to cover all these payments and related fees. If they don't get the funding they need, these redemption dates could be pushed back. Now, like most corporate filings, this report includes a section on forward-looking statements. This is basically a heads up from the company that some of the things they're talking about are just predictions about the future, and actual results could be very different. They mention factors like stock price volatility, global conflicts, government shutdowns, and the automotive industry's ups and downs. These are all significant risks that could impact their ability to achieve their goals. They also highlight the potential impacts of changes in trade policies, foreign currency fluctuations, and pretty much everything that could go wrong in the global economy and automotive sector. It's a long list of potential pitfalls, which is pretty standard for a company in this industry. So, what is the story here? Cooper Standard is essentially refinancing its debt. They're taking on new debt to pay off older, more expensive, and perhaps more complex debt. The high interest rates on some of the notes they are retiring, like the 13.50% ones, suggest that they were likely in a difficult financial position or facing a challenging market when they originally took out those loans. By refinancing, they are aiming to reduce their interest expenses and simplify their financial obligations. This is generally a positive move, showing the company is proactive in managing its finances. However, the success of this strategy hinges on their ability to raise the necessary funds through the new note offering. If they can't, their plans could be derailed, and they might have to continue dealing with their higher cost existing debt. The fact that they are offering these new notes only to institutional investors and not the general public also suggests they are seeking sophisticated investors who understand the risks involved in these types of debt offerings. Looking at their financial health broadly, while this report doesn't give us quarterly numbers, the decision to refinance significant amounts of debt usually means the company is trying to improve its balance sheet and cash flow. The redemption prices being slightly above the par value for some of the notes also hints at potential sweeteners or premiums offered to encourage early repayment, which again points to a strategic effort to clean up their debt structure. Now, the big question is whether these actions will translate into improved profitability and a stronger financial footing for Cooper Standard. Reducing interest payments is a direct way to boost the bottom line. But we also need to consider the broader economic factors and the specific challenges within the automotive industry as mentioned in their forward-looking statements. Volatility in raw material costs, supply chain issues, and shifts in automotive production volumes are all major headwinds they will continue to face. In my opinion, this move by Cooper Standard is a sensible financial maneuver. It suggests a management team that is actively trying to lower their cost of borrowing and stabilize the company's financial structure. They are essentially taking advantage of current market conditions, or at least conditions they anticipate, to get better terms on their debt. The key risks, as they themselves point out, are external factors and their ability to execute this refinancing smoothly. If they can pull this off, it should provide them with more financial flexibility. That is our breakdown of Cooper Standard Holdings Incorporated's latest report. What is your take on these debt refinancing plans and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.